Imagine getting paid on Friday. You check your bank account. For one beautiful moment, the number looks good. Then Monday arrives. Mortgage, car payment, insurance, credit cards, subscriptions, phone bill, utilities, groceries, and suddenly, most of the money you just earned already belongs to somebody else. You make good money, you work hard. Maybe even people assume you're doing well, but privately, you know something they don't. If one paycheck disappeared, things would get uncomfortable fast. If two disappeared, you might start panicking. And the scary part is this: you don't feel poor, you feel normal. That's what makes this dangerous, because in America right now, normal can be financially fragile. The US personal saving rate was just 2.7% in June 2026. Total household debt reached roughly $18.8 trillion in the first quarter of 2026, and the Federal Reserve found that only 63% of adults said they could cover a $400 emergency entirely with cash or its equivalent. So this video is not really about owning less, it's about needing less. Because the less your life demands from you every month, the harder it becomes for one bad month to destroy you. And that leads to the first rule. Rule 1. Build a life that survives a bad month. Most people ask, can I afford this? Wrong question. A better question is, can I still afford my life when something goes wrong? Suppose you bring home $7,000 a month. Your lifestyle requires $6,500. Technically, you're doing fine. Bills paid, food covered, car in the driveway, maybe even a vacation once in a while. But your entire financial life has only $500 of breathing room. Now imagine your income falls by just 15%. You didn't lose your job, nothing dramatic happened. Maybe overtime disappears, maybe commissions fall, maybe hours get cut. Your $7,000 becomes $5,950, but your lifestyle still wants $6,500. You're now losing $550 every month. The problem wasn't low income. The problem was that your life had no shock absorbers. Now imagine the same $7,000 income, but your required lifestyle costs $5,000. You have $2,000 of margin. Income falls 15%, you still have room. A repair appears, you have room. A bad month happens, you have room. That's financial stability, not making sure nothing goes wrong, making sure something can go wrong without taking you down. Rule 2. Fear fixed expenses more than expensive purchases. People love attacking small spending, the coffee, the lunch, the streaming subscription, and yes, small spending matters. But look at where American households actually spend their money. Average annual expenditures were $78,535 in 2024, and housing plus transportation accounted for more than half of that total. Housing averaged $26,266, and transportation $13,318. That's where the real battle is. Imagine two households earning exactly the same amount. Household A, housing $3,000, cars $1,500, other required expenses $2,000. Total $6,500 every month before life gets interesting. Household B, housing $2,200, transportation $700, other required expenses $2,000. Total $4,900. Difference $1,600 a month. That's $19,200 a year. Nobody clipped coupons. Nobody stopped enjoying life. One household simply built a cheaper machine to operate. And that household has something the first family doesn't: options. Because the most dangerous expense isn't always the biggest one. It's the expense you are forced to pay again next month, and next month, and next month. Rule 3. Stop spending future paychecks. Look at a monthly payment differently. A $700 car payment is not just $700. It's a claim on money you haven't earned yet. Next month's paycheck? Somebody already owns $700 of it. The paycheck 6 months from now, same thing. Next year, still paying. This is where people accidentally trap themselves. They make commitments using today's confidence about tomorrow's income, but tomorrow hasn't agreed to anything. Your employer hasn't promised you'll never be laid off. Your health hasn't promised you'll never need time away. The economy hasn't promised your industry will stay strong. Yet people routinely commit years of future income as though that future is guaranteed. Every new fixed payment reduces the number of choices available to your future self. So before taking on another recurring payment, ask, how many future paychecks am I volunteering for? That's a much scarier number, and often a much more useful one. Rule 4. Your emergency fund is really a fear fund. People call it an emergency fund. I think that undersells what it does. Cash buys something that is difficult to measure. It buys the ability to stay calm. The Federal Reserve reported that 63% of adults could cover a hypothetical $400 emergency entirely with cash or its equivalent. That means a significant share would need another method, such as borrowing, selling something, or otherwise finding the money. Now imagine a $2,000 problem instead. Car transmission, medical bill, home repair. Suddenly, the emotional difference between having cash and not having cash becomes enormous. Without savings, where am I going to get the money? With savings, that sucks. Those are completely different emotional experiences. Same problem, different balance sheet. This is why emergency savings are not dead money. They're stored calm, stored patience, stored negotiation power. The money isn't sitting there doing nothing. It's keeping fear from making decisions for you. Rule 5. Give your lifestyle a maximum speed. Here's where raises become dangerous. You get an extra $1,000 after tax. For about 3 weeks, you feel richer. Then life starts adjusting. Better apartment, better vehicle, more eating out, more travel, a couple of subscriptions, a nicer gym, and 6 months later, the raise is gone. Your income increased, but your financial life barely changed. So create a rule before your next raise arrives. For example, never allow more than half of a raise to become permanent lifestyle. If your income rises by $1,000, maybe $500 improves your life, and $500 improves your future. That's $6,000 a year directed towards savings, investments, or debt reduction. Over 10 years, that's $60,000 contributed before considering any investment growth. The alternative is frighteningly common. You earn $1,000 more, you spend $1,000 more. 10 years later, you have a bigger paycheck and exactly the same dependency on the next paycheck. Your career advanced, your freedom didn't. Rule 6. Put every subscription on trial. Monthly expenses are psychologically clever. $18 doesn't hurt, $12 doesn't hurt, $29 doesn't hurt, $15 doesn't hurt, until there are 15 of them. Let's say unnecessary recurring charges total just $250 a month. That's $3,000 a year. 5 years, $15,000. And this is before thinking about what that money might have done elsewhere. So every 3 months, conduct a trial. Open your statements, look at every recurring charge and ask, if I wasn't already paying for this, would I sign up for it today? If the answer is no, why are you still paying? People keep expenses because canceling them feels like a decision, but continuing them is also a decision. You just don't notice yourself making it. Rule 7. Make spending slightly annoying. Companies spent decades removing friction from shopping. One click, Face ID, saved card, instant checkout, buy now, pay later. Because every extra second between desire and purchase gives you time to change your mind. So put some of that friction back. Delete shopping apps, remove saved payment information, unsubscribe from promotional emails. For non-essential purchases above a number you choose, wait 72 hours. Not because 72 hours is magical, because emotions expire. Picture something you desperately wanted 6 months ago. There's a decent chance you barely remember it now. That tells you something important. The desire wasn't permanent. You almost made the expense permanent anyway. Rule 8. Calculate the recovery time. This might be my favorite rule. Before a major discretionary purchase, don't just ask what it costs. Calculate how long it takes you to recover the money. Suppose you save $600 per month. You want to spend $3,600 upgrading something that already works. Price, $3,600. Recovery time, 6 months. Now imagine $9,000. At $600 of monthly savings, 15 months. Suddenly, the purchase isn't just an object. It's 15 months of progress. That doesn't automatically mean don't buy it. Maybe it's worth it. But now you're making the real decision. Not, do I want this thing? But, is this thing worth delaying my financial progress by 15 months? That's harder to answer, which is exactly why it works. Rule 9. Separate nice to have from expensive to maintain. There is nothing wrong with buying something nice. The danger begins when nice things change the operating cost of your entire life. A vacation? You pay, you enjoy it, you come home. Done. A permanently more expensive house? That may raise costs every month for years. A luxury vehicle? Potentially a higher payment, insurance, repairs, registration, and depreciation. One-time luxury and permanent lifestyle inflation are not the same thing. Minimalist money doesn't require eliminating pleasure. It requires recognizing permanence. Ask, will this make 1 month expensive or will it make every month expensive? That distinction can save you enormous amounts of money. Rule 10. Keep your financial burn rate low. Businesses track burn rate. You should too. Your personal burn rate is simply how much money does your life require every month before you get to choose anything. Housing, transportation, debt, insurance, utilities, food. Required commitments. Suppose your burn rate is $7,500 per month and you have $30,000 available. You have approximately 4 months of runway. Now imagine another person has the same $30,000, but their burn rate is $3,750. They have roughly 8 months. Same bank balance, twice the time. Which person is richer? That's why net worth alone doesn't tell the full story. Money is only powerful relative to how fast your lifestyle burns it through. Rule 11. Make every raise increase your survival time. Here's a financial metric almost nobody celebrates. Months of freedom. Let's say essential spending is $5,000 a month. You have $10,000 available. 2 months. Then savings grows to $25,000. 5 months. $50,000? 10 months. And suddenly the numbers on your bank statement become something more meaningful. Time. Time to search for a better job. Time to recover. Time to help someone. Time to make a decision without panic. Now imagine you receive a raise. Most people ask, what can I finally afford? Try asking, how many months of freedom can this raise buy me? That one question changes the direction of your money. Rule 12. Build financial stability before you build financial status. There is a point where money stops being mathematics and becomes psychology. You see the coworker's new car. The neighbor remodels. Someone posts the vacation. Another friend buys a bigger house. And without anyone saying a word, your own life starts feeling smaller. Nothing changed. Your house didn't shrink. Your car didn't get worse. Your phone didn't lose features. But your definition of enough changed. That is one of the most expensive things another person can do to you without touching your wallet. So create your own definition. What does enough housing look like? Enough transportation? Enough convenience? Enough entertainment? Enough lifestyle? Because if you don't define enough yourself, the world will keep moving the finish line, and you'll spend your entire life financing the distance. Now, look at the bigger picture. Household debt reached about $18.8 trillion in the first quarter of 2026. The personal saving rate was only 2.7% in June. Housing and transportation consume more than half of average household spending, and millions of households are trying to build financial security inside that environment. You cannot personally control interest rates. You cannot control inflation. You cannot control layoffs. You cannot control what the stock market does next month. But there is one variable you have enormous influence over: how expensive your life is to keep alive. That number changes everything. Picture two people earning $100,000. One needs almost every dollar. The other has deliberately built a life that leaves $20,000 or $25,000 behind each year. At first, they may not look dramatically different. 5 years later, very different. 10 years later, potentially completely different financial lives. One person spent years increasing what their life required. The other spent years increasing what their life could survive. That is the real minimalist money mindset. It's not how little can I own. It's how much financial pressure can I remove? Because every obligation you remove creates breathing room. Breathing room becomes savings. Savings become runway. Runway becomes confidence. Confidence becomes choice. And choice is where money finally starts feeling like freedom. So if you remember only one sentence from this video, remember this. Build a life that doesn't require everything to go right. Because you will have bad months. Cars will break. Jobs will change. Markets will fall. Unexpected bills will arrive. Life will eventually refuse to follow your spreadsheet. The goal isn't to become rich enough to avoid uncertainty. The goal is to become financially stable enough that uncertainty doesn't own you. And that may be the real power of minimalist money. You don't need the largest paycheck. You don't need the nicest things. You need enough distance between what you earn and what your life demands, that when something goes wrong, you still have choices. And here on Math Invests, that's the math that matters.